display.
Mama Ivy tipped $100. Hex.
And then, just like that,
Pipe in the chat!
Hello, Mama Ivy and traders. Welcome to the stream, the early stream, where we're just, it's just kind of a time where we know the algos are going to be freaking out. They already have, right? The basis points increased 25. Okay, wow, big surprise. But it doesn't really matter if it's surprising or not. The bots are going to freak out anyway. So Bitcoin just moments ago, after that initial announcement, right, the meeting starts in like 15 minutes, 16 minutes. We got as high as 28,932, but 28,800 has been the level, we've just had up forever because it's been there forever. And it was formally tested for the past, 7 hours, 6 hours on the last 4-hour candle and now this candle. And, just painting maybe what's happening here, upsloping consolidation. So if you're unable to breach this level, you can't be surprised if we finally get that pullback and that flush with the overall market, because whatever happens, man, I mean, it's going to be one way and then the exact opposite after or before, whatever. So this is a big old like gamble day, coin flip. This is what happens every time Jerome Powell does this. So yeah, that's it, right? So interest rates going up. If they didn't, there'd be panic. The fact that they are going up is like, wow, more stress on the system, on small mid-cap banks. Yep. So I think that's the plan, though, right? The plan is to destroy all small mid-cap banks that bought bonds a year plus ago, and what they bought is worthless. It's trash. It's crap, because the Fed keeps raising interest rates, so the new issuance of bonds comes out. So why would anyone own those when they could own the better ones? And that's what's happening. That's what happened to SVB before they collapsed, and it's happening all over the place. Maybe it's unintended consequence, but seems like if you were gonna try to create a central bank digital currency, this would exactly be the way you do it, right? Because the only impediment for central banks to have a central bank digital currency would be the small mid-size cap banks. So when they collapse, then the too big to fail banks that got pretty much bailed out in 2008 and were nationalized then, they will then buy out or bail out the small banks. And then all of a sudden you have everyone corralled into just a few big banks that are backed by the FDIC for unlimited amount, by the way, trillions of dollars. That doesn't even make sense. There's no math in this. It's crazy. And then, yeah, it'd be very easy to roll it out then. So this is the route that one would choose if they were trying to do this. So here we are. Welcome to the stream. The early stream, I guess. We get on like audio levels. I don't want to ruin the stream, with that stuff. What could go wrong? Yes, what could go wrong? Well, they don't like what you said. They don't like how much you've traveled. So, yeah, they'll just freeze your account, your central bank digital currency notes or whatever, right? And this is why Bitcoin's important. This is why Bitcoin Live every single day for 5+ years. BTC Live, over and over and over again. Audio's okay, or perfect. Dang, man. All right, so if we want to, we can just look at the quad screen here. Whoa, that's not the quad screen. Hold on, my computer restarted because of an update last night. So all my, that's wild. Well, Vet Moonboy, hype in the chat for Vet Moonboy. Hold on, I have to fix this setting. Wow, hold on. Un momento. Okay, here we go. So here's your S&P 500 top left. All right, top right Dow Jones. Bottom left's gold, and then the bottom right is the US dollar index fund, which is inverse correlated to everything. As you can see, it's dumping, and it just hit its lowest price since February 3rd. All right, so DXY flushing is always good for everything else, because the US dollar's the common it's the denominator of everything. So I'm trying to remember here what the order was. I have to figure this out. So S&P. Oh, S&P will be over there. The Bitcoin bar will be there, and then gold bar. Okay. I'm just getting this set up for the speech because Jerome Powell will be in the middle of the screen while he talks, while we just look at the price. So let me switch this up real quick. S&P here. All right, and then Bitcoin over here. There we go. And as you can clearly see, even like on the 60-minute, just the price action you're receiving on a less significant time scale, how many hours of testing and failure, including this previous, the last 20 minutes of failure to break it. This just shows you how real it is. It is just not a joke here. Again, you got to go back to 2021 a couple times to understand the significance of it. And it's just, man, like after such a 50% rally, chat, 50% in less than 2 weeks on Bitcoin, if you're testing the next major inflection point, you're not going to be off base by concluding maybe, just maybe, it's possible that an inflection point could play a role as a potential short-term reactionary or reversal area, right? Like, my God, if you break through it like nothing, heck yeah, man, you got 30K, 31K. But things are volatile. They were volatile, and they're going to remain volatile. They're about to, we're not out of the storm now. I think things are about to get real volatile in about 10 minutes. When Jerome started speaking, we had a 2.23% swing from the low to the high in this previous 20-minute period. All right. Okay. Thanks, Mama Ivy. Yeah, we'll look at Hex right now. Why not? Hex up 6%. Well, tweezer tops. I would not on the 4-hour. Whoops. Let me just make sure I had that right. So we're good. So Mama Ivy, thank you for the $100 contribution in seconds. And that right there, where the tweezer top that is perfect, where it's being painted, is at that inflection point. So this is a perfect area where somebody might say, hey man, it might be a great time to take some profit after it running up, I don't know, from the bottom 475%. So that is what's happening right now on Hex. At the resistance, once you broke this one, probably this, and you're at it, and your tweezer topping on the 4-hour. Hard to ignore that. You don't really see where's the tweezer top? Yeah, where's the tweezer top? You don't get it very often. So I'm just saying it's there. It's being painted, and it's selling off. At one point, my God, it's up 6% now. But dude, it was up 13% earlier. Again, my God, unstoppable. This asset's been killing it. All right, but we know quantitative tightening's over. That's certain. Remember how many hundreds of billions of dollars they've infused into the system since last week. That'll show you. You just have to look at the chart to see it. Where about half of the reduction in the money supply, all right, on the Fed's balance sheet, that is been put back into the system in a matter of less than a week. So that is crazy, and that means literally no more quantitative tightening. That was it. We did it for a year, and it blew things up, and now the money printer's going burr again. It may not immediately correlate into number go up on all assets, but you think in time it would manifest into that, especially something like Bitcoin, with this whole dystopic central bank digital currency unveiling, right? So yeah, still below it and may not get back above it for a while. You just, that was it, man. Whether it's 0 or a million, definitely you think 28.8 soon, and it's happened. And again, for the past 5 hours or 4.5 hours, testing that. It's one of the and the Discord posted me the link, the official link to Jerome Powell's speech, so I can just get this, get it primed and ready to go. Thank you. Thank you, Cyberg. Appreciate it, man. Thanks, everybody. All right. Probably got the weird music on, like always. They do have the weird music on. Super depressing. Sounds depressing anyway. 120 BPM. Not depressing. Okay, so we can... any altcoins do anything? I mean, you know, what's been going off? My alert's been going off on Bitcoin dominance earlier today. I mean, just recently too. It's kind of weird how it works. I don't know. It's not very good at giving alerts, but something that happened was my beep, my alert went off, you know, at the highest highs. I mean, it was like 47.99% I got the beep. And we're just waiting on 48.29 to 48.7% up here at the top of the mega Wyckoff accumulation range. Waiting for that to be fulfilled, just not yet. And here you go, right? As we can see, Bitcoin selling off some more after testing and failing to break that inflection point. So you just don't know. We're looking at this now. It's selling off, but dude, the Jerome Powell are speaking. I mean, just the same type of price action to the upside could be occurring. You just don't know. Where now the S&P is pulled back off its highs. It was at 4,032. It's now at 4,007. Gold also pulled back a little bit, but the DXY near its lows. These are all 60-minute time scales. This is for the sake of price action. You know, because normally when we're looking at this, we're looking at it because Jerome Powell's speaking and stuff. So about 5 minutes. Hope you got your beers. I know a lot of y'all are tailgating outside of the building, or the Federal Reserve building. If you are, send pictures and video. All right. I think Batson just did a keg stand. I know there is a keg out there outside of the meeting. You know, show them who's boss. Yeah, Bitcoin dominance is really strong here. I don't think there's any altcoins out there that have really been doing anything today that stick out. FTM's been holding up pretty well. Cardano up. You know, Cardano's trying to do some stuff. It's trying to get back above 37 cents here. Massive bullish engulfing candle yesterday. Completely forgot to look at it. So I guess I'll just take a moment to look. Someone in the comment section of the stream was just like, something's going on. Is it a coincidence that Ray didn't look at Cardano because it pumps so much? And it's like, what? Yeah, dude, I'm working for Cardano's main competitor, bro. You got me. No, it's not like that. I just forgot. Like, wow, because it's just not that memorable of a coin, right? It's always garbage. But yeah, it's cool, dude. It's cool that it's back above this one little level. There's so much to be done. Back above the 200-day moving average is great. So, Bryce.
Thoughts on GMX?
Thank you for the 10 super chat. Remember that time that there were rules? I know, man. I'm such a bad guy. I know. Believe me, I get it, right? But there are rules. If I start doing, my thoughts on GMX, I don't really know. I don't know. I don't have any thoughts on it without looking at the chart. You know how that goes. Thank you, man. So just keep an eye on this. I also have the quad screen for the cryptos up too. Not sure how big of a deal it's going to be. I'd rather be on the other one. This is Bitcoin top left. Ethereum top right, XRP bottom left, and BNB bottom right.
There you go.
Oh, Bryce, thanks, man. I don't know. We can look at it. Thank you, dude. Okay, so I mean, what would you think, chat? What's your opinion? Did you like the quad screen of the big 4S coins, or would you like the diversified blend with DXY getting nuked right now? Again, currently breaking below that February 9th and 14th level, and at your lowest price since the 3rd, so it's been well over a month. In fact, you know, what, going on 2 months, right? 7 weeks or so. And I guess that was a support, a 60-minute support of, you know, of some sort. Breaking it, man. Still no Jerome Powell yet. We got about 2 minutes. Let's see how punctual he is. Let me see if I can I gotta get my browser set up, so just give me one moment because I just want to have this kind of ready. And then I know what my browser source is gonna be off right now because of the updates. We're just going live to get it going, man. Bueller? What the heck? Too many sources, man. This is what happens. Wish there was a way you could like alphabetically search on OBS. That'd be nuts, dude. Okay, we have that, and we have this. All right. Cool, cool. All right, we're about to be there, being ready and stuff. So we're gonna do it like this. It's gonna be really nice right there. How's that? That looks pretty good, right? Hey. We were gonna do things. Okay. That's weird. Okay. It's fine though. Okay, GMX. Is this what you wanted, dudes? I mean, I don't know. I mean, whenever you get stuff. All right, here we go. I can't. This is GMX, but there's not much. It's uptrending, but you know, it's not making higher highs yet from the 16th. So we do have activity here. Ooh, that's nice. I can have that up right there anyway and still look at GMX. How about that? I don't know, man. Is it actionable for a long? No, not really. Not that I see. See how well respected this channel is, though. It'd be like that, or all right, here he comes, chat. Here he comes.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation.
There's bears out here.
We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions, meeting by meeting, based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes, maybe some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path will might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time. And in principle, if that means that monetary policy may have less work to do. We simply don't know. So
Do you have concerns that the hike you did today could further exacerbate the problem in the banks?
no, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular, our lending facilities, the discount window, and also the new facility.
Nick?
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and, the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do. And that therefore they were including that in their assessment, and that if that turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been. Remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's people. It's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first part, the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor market. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation? So
Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And what we did was early Monday morning we sat down and said, let's do this, and he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Chair Powell, Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes, I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely absolutely the same. The story is intact. So it's really three parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February and we still don't have now is a sign of progress in the non-housing services sector, and that is that's just something that will have to come through softening demand and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. People are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina. Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, and a very, very fast run, faster than the historical record would suggest. So for us, for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies.
Happened.
It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear, to your last question, it's clear that we do need to strengthen supervision and regulation. And I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
Sorry, and the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue, but nonetheless, this still happened. And so that's really the nature of the of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Let's go to Rachel Siegel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we've well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong, it is sound, it is resilient, it's well capitalized, and I really don't see that as at all analogous to this.
Question, would you be open to an independent investigation separate from the Fed's probe?
I welcome it's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails, there are investigations, and of course, we welcome that.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
And if I could follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
If you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under Emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right, we have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to the, in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Chris Rugaber.
Thank you, Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end? Thank you.
No, absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways, so let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's been quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating, but nonetheless what happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Go to Greg Robb.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been, the markets have accepted it, and it seems to have gone well, and I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
Nicole.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And there's really, we have to bring inflation down to 2%.
I don't know.
The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to.
Mr. Mike, please.
Yes, sir. Historically, it's been hard to contain
unemployment. And the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
It depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down. Because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several of those, and they're very good for people. You see late in an expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Jean. Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
Oh, here we go.
It's too early to say, really, whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. The question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
32.33, repeating, of course.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious regulatory, particularly immediate attention. That's and I guess there were 6 of them. So.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about. What can we do to make sure? But again, that's not for me to answer today.
So you don't have specific thoughts on that?
Well, if I did, I wouldn't share them because I really, this review's going on. And, I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. It just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, to this work, not connected to this bank. And under again, Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if credit were
okay.
to tighten enough, if that would prompt a rate cut.
So financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it? And then, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, so that's all I have to say. So,
Thank you.
thank you very much.
All right, we're back. That was it, man. It was a typical speech, or typical price action from the speech, and nothing changes ever, because half or more of the job of the chairman of the Federal Reserve is virtually, it's like, it's a PR job, right? Public relations. Not saying anything crazy or anything like that. I mean, because, everything, all the algos freak out to anything he says. The market's like legit dumped to their lowest levels, like moments after the first time the word recession was even brought up. But now, as you can see, right, since he's done speaking, we're starting to rally off those lows. Okay, no big deal, man. This is like it. This was what you consider surviving. Things are going to go back to normal now, like in terms of like what was happening, I would think, right? I mean, Bitcoin did break, okay? Bitcoin did break that little wedge there for now. Working on a bearish engulfing candle confirmed in 44 minutes. But if it was to happen here, it would be the most respectful place ever, right? TA respectful. I would say any kind of reversal or reaction here would be dang it, man. Can never find this, so TA respected. It would be TA respected, right? If you did reverse here of any sort. Even if you reverse here, you react here, whatever, it doesn't mean it's like done. The whole run's done. It's just pullbacks happen at areas where potential pullbacks happen, where reversals have happened in the past. Here we go. If Bitcoin reversed at 28.8, it would be like TA respected. It'd be like that. Anyway. So yeah, things were pumping, they were dumping, some alerts were going off, things were hitting their session highs, and then of course the pullback. But here we go. I mean, like, you just look at the S&P future is just already back to where it was. I mean, this is just whipsawing in between. This is what you get every time he speaks, and that was it was a 1.77% swing in price from the high to the low, and now you're already back to dead middle, trying to go green on the 60-minute candle. No big deal, man. No big deal at all. It's the aftermath. You're looking at the aftermath of it. So we want to look at the other cryptos, if we, at the same time, you got Ethereum top right that sold off not too bad. I mean, XRP, good God, from XRP's high yesterday, right? And from the high of the day all the way, XRP's down 13.5. Earlier it was down about 15%. Wow, still doing oh, they're doing construction or renovations above me. Nice. Yeah, sorry, dude. I don't even. They're like literally right above me, like hammering the ground. Like they're like, "Oh, Ray's live. Let's just like be as loud as possible right above him." You can't even make this up, dude. All right, so looking at the XLF in the financials, it didn't do anything. It's down 0.88%. No big deal. You think eventually $30, and then after that, $26. Yeah, they just wanted to be on live stream. Seriously. It's good you don't hear anything. I'm like preventing you from hearing it, I think. There's noise canceling, but it's also just like I'm muting my mic anytime they start going at it. One asset that was just not affected at all by this crap, I mean, really, is AMD. AMD has been spectacular, working on a massive bullish engulfing candle in your highest daily candle close since August 18th. This is a big breakout, $99.98, $100 on AMD right now. This is a breakout level, psychologically speaking, and just very real. Look left. I mean, you've had it as a December of 2020, breaking that again. I mean, that could manifest into way higher prices, which, not surprised on something like this, and NVIDIA, that had just been destroyed for so long. Just so many higher lows now, back tests of resistance as support. Very nice. Very, very nice. TK, which was the one that, was TK the one, or was it another one? TK has gone nuts. It's today TK is at its highest level since November of 2018. Wow, talk about like Wyckoff accumulation maybe. I mean, there's like, where's the resistance here on this one until like, look, right? I mean, how much higher?
Gentlemen in the mix.
TK is marine shipping, transportation. Wow. NVIDIA is also killing it, man. NVIDIA's at its highest level since April of last year. You're getting closer and closer to 52-week highs on it. Beautiful. Hey, talk about TA respect. Look no further than NVIDIA. That was gorgeous, right? And the AI narrative, I guess, is what really propagated it. And so you're just at that 88% retrace. From that high to low, you're breaking the 886 now. So are we talking about maybe a major 886 here, right? The high to low. And an 886 there is a 321. This is this is just what NVIDIA does over all these years now. It's a beast performer. Bitcoin off its lows, 1.78%. Something called Perpetua Resources that was hitting a bottom, a low. Someone requested, I think I added it to my list because of that. Terrible volume. It's like dead volume. But Yeah, just it's up today 3.6%. You know, you got these miners, and I know CDE was really like disappointing and stuff, but you got to wonder if this is maybe the big type 2 here. Maybe the type 2 on the weekly, you know, getting back above 340, 360 would be, that's what you really need. Do we have this going on with CDE? A weekly type 2 would be unreal. Good God. So just pay attention. Maybe, you know, you don't have to like long it. I know it's rough, man, when it topped out at $4+ and then went all the way down to 284, but just let's see what happens here. Gold is getting close to all-time highs. And another one, another miner, New Golds. Speaking of incredible M shapes, I mean, this is like out of this world good. I mean, look where it's all at. I mean, this is such an impeccable argument for upside, even if it failed, right? I mean, just if you're not going to identify an M shape at an all-time low from 2008 and then buyers defend that level on the second attempt, higher low, dang, when would you? Like, it's just... This is something else on the weekly here, not the daily, the weekly. Big pattern. It started, I mean, it's a 1,000+ day large structure. Beautiful. Shake Shack up 2%. This is an incredible 2. Massive M shape. With already a type 2 possibly put in, right? 1,000 day plus large pattern. M shape. Crazy. You got to wonder here about EWI. This is the South Korea MSCI. What is this? Some sort of, is it bonds? There was like this crazy M shape here, and you know it's still valid. You're still making a higher low here from the previous low. You got to wonder, is this going to play out? Up 1.88% today, above the 200-day moving average. Certainly broke some sort of supply line. I think even back tested it, right? I mean, just plotting it like that. Yeah, you break out, you back test. That's interesting here for maybe a lot more upside for a big retrace. VIX walling out. That's what the VIX does though, right? That's its thing. If you look at Under Armour, it's up today as well. Man, it's so like you just talk about how close it is to maybe good stuff. Look where you are. You're just this high from 2007, trying to hang on, but you're below it right now. So the last week was a possibly a reversal candle, maybe. You get back above 921, could be in some decent shape, but dang, man, it's just it'd be scary down here, even though it seems like a low risk area. What if it doesn't hold? Okay, Under Armour. I'm just looking at some of these gainers today. I'll look at the losers too. There aren't many like crazy gainers. Carvana, of course, is up 10%. It's up 10%, down 10% every single day, just about. So, not really worried about that one. Shoot, dude. But, I mean, it's really hard to argue here. You have to, like, look, man, it's garbage. We know Carvana's garbage. It's only been garbage. It's a loser. It lost over 100% of its value from the high. But look where it is. There is this low from May of 2017 on Carvana. And guess what's happening today, being up 10%? It's gapped up and broke back above it. Now it's like coming to test it. It's like, do you think buyers will defend 821 when it happens? Because I think the gap's going to fill and all that. But you got to wonder. Got to wonder on something that, you know, is so garbage. It's at these inflection points, and you just got to wonder what buyers are going to do to it, you know. Critical areas, cue up the song. Loading up bulls, dude. They're not doing anything, man. Or were you in the meeting with them, dude? Some people act like they're in the room with a composite operator, and they know exactly what's going on. It's like, what, dude? All right, USB U.S. Bank Corp's down almost 5%. And massive bearish engulfing candle getting put in today. 32 minutes till it's closed. Wait, is that, yeah, no, we have still another hour and a half till the close. So you're not really in power hour yet. But until, it says this daily close is weird. What crazy is maybe my time's off. That's what it is. That's it. All right. So yeah, sorry. My computer's time is still wrong. Not used to that. So it is official.
It's time for Power Hour.
We are in Power Hour, certainly. I'm readjusting my my mixer over here. Okay. All right, DXY starting to roll over again. Nice. Very nice. It was pumping, dude, and it's dumping again. Gotta love it. Take us to the lows, man, right now, so everything else can pump. It's unfortunate Bitcoin's not rallying back like gold and the index funds are. Yeah, you know on USB, the gap's going to fill down at 34.47, and, that's just way lower, man, in time. They're the ones that are, we're going to buy Credit Suisse. Okay, dude. Wow, Boston Properties is still crashing, dude. This one is destroyed. Like, just a day or two ago, making its lowest price since 2009 and like just collapsing, man. I mean, look at this thing. Since this like wedge broke down, like since the breakdown, I mean, it's down 55% in 300 days. And like from that high, when the back test these levels over here, I mean, it's down 62% in a little less than a year, about a year. So, but yeah, 44.83 is the 2009 bottom. I mean, like just that spring back test. And you can see 2004, and then the peak from 2000, 2001. I mean, that's where BXP is headed. Disgusting, man. Imagine like holding this long term. What a loser. Schwab down, getting wrecked, down 4.5%. You got to believe this is what's just happened on this one. Is so sad. Like, look, $60. What was once support is, yeah, resistance now, man. Support is flipping resistance, and you know where this is probably headed, dude.
Gentlemen, in the mix.
Yeah, there was a time where like Bear Stearns, was collapsing, and it doesn't happen overnight. It took like 3 months for like a bear market rally to happen on the financials before the rug already pulled. But another rug got pulled. Whoa! So look at this. I mean, this is just not a joke. This is May of 2018 level, and just for days now, a whole week, you're just below it, regarding it as resistance. That is super bearish. I mean, whatever. Just keep an eye on all. I mean, this is like the ear to the ground quad screen, right? Bitcoin top left, S&P top right, gold top or bottom left, and then US dollar index bottom right. Yeah, yes, multiple assets. A lot more big downers than big gainers today. I mean, like Square's down 4+%. Doesn't look that hot, really. But still, it's okay. I mean, probably going to put in a higher low than previous low. I mean, this will probably just be a through rising value at some point, hopefully. But yeah, just not a good day today for some of these assets. We've been live now 1 hour and 30 minutes. If you're enjoying the live stream, hit the like button, the bell, the sub. Be sure to join the Discord if you haven't. Let me give you that link. The link is pinned, but I'm going to definitely give it to you again in the chat right now. There's that invite. Go join or be destroyed. Yeah, like Rite Aid's about to make all-time lows. If you remember that one, it took out the February 2009 all-time lows. Well, hold on, let me see. Doesn't it go back to like the 70s or something stupid? Yeah, man, I already took them out. Wow, so bad. All right, Rite Aid had an all-time low at 313 in 1974. All right, and look what's happening. It was last week you broke it for the first. It was the first time testing that 1974 low last week, but then you broke it like it was the biggest joke ever, and now you're following through this week. All right, 1974. Way back. I'm sorry. Yeah, 1974. And here's 2023. You didn't even. There has not been a test. It's like capitulation. You capitulated through it. And now you're just getting ready for your lowest low ever. I mean, it can only go to 0, so. Big yikes, man. Okay, so like it was crazy about more retail, like another brick and mortar. It's kind of concerning. I don't know how this is going to play out, man, but you know, the Gap store, GPS, the ticker, you know, you had this crazy inflection point that takes you to 1992, 1996, 2002, 2008 and 9, and then just recently, like, you know, 22 kind of type 2 return to this M shape, and look at you now. You're just right back at it, and you're rolling over, and you'll soon be testing 841 again. So will that hold this time? Man, that's like a good question, because shoot, dude, if we're going for a recession, probably not. Yeah, Bank of America getting ready to also make its lowest lows since, I mean, in years, and like multi-year lows on Bank of America coming. See how close you are to that? I mean, the banking crisis that we dealt with last week, it's not over, chat, at all. And these charts are telling you it's not over. I mean, the impulse itself, there hasn't even been consolidation. No, dude, it's about to, like, this wave. We're still in the middle of the wave from last week. You can look at all these individual banks. I swear. It's like every time I try to unmute my mic, the piece of trash up there keeps like using this hammer right above me. I can't believe it. I can't escape it, dude. Can't escape the I just have to end the stream. This is just too much, man. We have more losers today. Like Wells Fargo. See how Wells Fargo is about to be at $37, and when $37 breaks, it's over. Like you're gonna see like really bad things are gonna happen when the banks continue to implode. But hopefully, it's good for tech still, because tech is not really affected like this at all. The charts just don't look anything the same. Yeah, Bitcoin's near that session low. I mean, the most appropriate level ever for a reversal like this. I mean, I just don't know. Like, you're not watching the streams, or you're not listening to the streams if you don't understand why I have levels that are gray, that have been gray for a very, very long time. This is it, man. This would be the most incredible area for a reaction reversal, because that's like TA. That's the level being respected, the TA being respected. Yeah, they are S coins. I mean, the banks are, yes. I guarantee you there are so many more insolvent banks out there. We just don't know about them yet. And I think this interest rate increase is going to put stress on the system, and I think more are going to get caught with their pants down, and we'll be finding out. The composite man will start announcing different, news events, news-driven catalysts that will destroy these banks more. Wow, dude, you want to see how terrible one is? This is almost like you go short here. I'm not kidding. If you want to short banks, BK, Mellon, the Bank of New York Mellon could be the perfect one, because look, what was once resistance from August of 2018 is now, yesterday was formally back tested as resistance, right? You broke it. Now it's resistance. There's an unopened gap, or unfilled gap, excuse me, and a bearish engulfing candle is being put in, and at the same time, the 200-day simple moving average is being re-breached to the downside. That is like a perfect area for somebody to take a shot on being bearish. The levels being broken and back tested and bearish engulfing and that's so many variables right there, dude. At least for continuation. One that makes a lot of sense for more downside was 3M Company. It was always on the table. I think you would wait for it, $90 or so. And you're rolling over today, and I think you're going to see the lows. I think you're going to see new lows soon. It's the deep crab pattern. Yeah, a lot of these just way lower, man. And I also think the same case for energy stocks, man. I don't know, like rotation, man. Or look at something like Lockheed Martin, man, where it's like double top, but like weekly double top. I mean, that does not look bullish right there, does it? It looks like so much, like some just distributions going on, and you're back below the levels that you needed to be above, you'd think, right? That's pretty bearish up here, big time.
Gentlemen in the mix.
We got 16 minutes till your, to the closing bell. If you're enjoying the live stream, the like button, that bell, that sub. I'm gonna try to stick around, man, for that. It's just tough, man. Really tough with the just incessant disruptions. Should go back to Austin or something. Go somewhere else. I don't know. If you knew the improbability of someone doing a major, like, unbelievable, like, I don't know, complete gutting and probably throwing in hundreds of thousands of dollars into something, if you knew where I lived, because I am in the penthouse, but like half of the penthouse is like kind of like boxed with another one, so it's kind of a weird thing. They're all like that. This just happens to be where this office is under the other one, but like other parts of my building are not, below anything. So it's just like how many people are in this unit, and I just happen to pick the one, like where this is happening. It's terrible luck, but just like the flood in Birmingham. All right, Bitcoin's still near its lows here. Still near the lows. Good Lord, man. Some of these altcoins are smashed. Look at this. Tron Connect, Justin Sun's S-Coin, Communist China, is down 11.88%. I mean, it is not far off from death. It never broke that 7.2 cent resistance ever. It just went to test it and is reversing there. Yikes. XRP is down now 11% and just gone. And it's gone. It is that. That's what you got happening right now. Maybe back testing this level. Has resistance, right? But there you have it. Ugly. What a hangover day for XRP, yeah? Oh, Justin Sun sued. Good, man. Sued by the SEC. And there you have it. There you have it, man. Good. I mean, like, they just, my thoughts on that guy. Like, he's no savior. He's just been in the space and scammed people. That's how he got rich during the ICO bubble. Owning a crypto in 2017, being backed by the communist government. Great. Friends with CZ. Yeah, he did it, man. He didn't create a working product that actually helps people. Yeah, who'd have thought, man? The biggest surprise ever right here. All right, Bitcoin 27,000, about to crack 27,000, falling the 26s, and then the S&P's rolling over too in power hour. Buy my S-Coin. Huh. Yeah, it's all fun and games, dude, right? Yeah. And then look at Ren. This is the levels, man. Like, sometimes they break, but sometimes they just don't break, and that's why they're targets for trade setups, right? And if you were blessed enough to see 14 cents be broken, yeah, you'd head on to the promised land, but that just can't happen. Like, the sellers are not letting that occur. I mean, that's the third, fourth attempt now and failure, and now you're down 11% today. There's a lot of coins down almost 10%. I mean, you got OMG that had such a day yesterday. It's over, man. Like, you run up to 250 and then you reverse, and that's it. Shoot, dude. 3 black crows right there, if I've ever seen them. Comp down 10% roughly. Yikes, man. And that's real bad. Like, that rectangle Look how it was formally back tested as resistance and just rolling over now. Ugly, man. Real ugly and collapsing in real time. We got ourselves a dump. Wow. Bitcoin, $26,900. Let's go back to it on the big screen here so you can see it. Down 4.71%. Bearish engulfing candle occurring at the 28.8 level. But I mean, my God, man, if that's not a level where something like this would happen, then then it'd be random, right? This is the most unrandom area ever. It just is, man. Is anyone in here like genuinely surprised about this? I don't know how you could be if you're like a member of this community. Waiting for someone to answer. Say yes they are or they aren't. It is a real level. Gold still looks strong, man. Still really strong. Like as risk is going off, it looks like across the markets, you have gold just still so elevated. Incredible. Something's going on with gold, chat.
Gentlemen in the mix.
Yeah, Brian, of course, man. Of course. Well, you're up in Chicago. You can do something, man. Take action, bro. All right, we have less than 10 minutes until the closing bell, and you could see that the S&P futures just hit the lows of the day. Just last hour, it saw the highs of the day. And so from the high to where it is now, oof. I mean, a 2% swing, which it's an index fund, dude. I mean, it's not like one asset, so that's a pretty big deal. So that's a big move. I was told 90 days, 1 million Bitcoin. Yeah, dude, well. So you're saying there's a chance, I guess. How many days left? What is it, like 80 days now? Gold is going green on the 60-minute. Incredible. As the S&P sees its lows of the day, gold is working on its highs of the day. Same with Bitcoin seeing its lows of the day. Interesting dynamic right there. So where would the supports be on Bitcoin here? You'd look left to see that there's very little to none. There's none here. I mean, I think you're talking probably like 25K, 25.2 is a support. Potential support. It's old resistance. Would it be support this time? Maybe. Gotta admire that, man. I don't know. I don't like when Bitcoin dumps, right? I never do. But like if it reverses somewhere where it made sense to reverse, I'm gonna feel better about it. And I think you should too. That's the whole point of like we're all here together, why we like charts, why we respect the TA because of this stuff like today. Perfect. The S&P 500 is also, again, at its lows with less than 8 minutes till the close. Gold still rallying off its 60-minute low, 1954, 1972 now. There it is, Bitcoin at its lows of the day, $26,800. We continuing to dump, man. Do not be afeared. Oh my God. And thanks for the 930 people tuned in. Been pretty stable concurrent viewership throughout this stream from, you know, the entire meeting of the Fed, moments before and after. So we're just waiting to see, you know, we're waiting on Apollo Creed's trainer to say, throw the dang towel. I think he said it a few times, but the The market says not yet. Don't throw it. Don't throw the towel, Rocky. Here it is, lows again. We're seeing the lows right now in real time on the the S&P futures and Bitcoin and many alts. Altcoins getting smashed. We have Tron now down 14%, XRP down 12%, REN down 11.6%, OMG down 10.5%, and then many assets in this space, all down way more than 5%. The average down is, I would say 6 to 8%. Across this market and the crypto market. These things happen, man. These things happen. All right, there it is. You're continuing to dump, right? That 60-minute 200, which I don't really care about, but it's happening. You're testing it right now. Hey, that bearish divergence finally played out, didn't it? Yay! It did it, man. My God. Bitcoin lowest price since the 18th. About to take that out, though, looks like. Well, we knew it would be possibly an eventful day. And, we were not lied to. We were definitely, it was worth the cost of admission, right? Maybe Christmas will come early and Tron will break that support. We've been wanting it to forever. Them getting sued is great news for all people in the world with integrity. It's a win. Thank God for Mama Ivy. That's all I can say. My God, dude. Tough room. Gold there it is, rallying, man. So close. So close to the highs of the day. It's not a wrecking ball, man. Nothing he said was surprising. I mean, kind of the way he did respond to the question about will there still be a soft landing. He definitely equivocated and did. I mean, reading him, it wasn't good. I mean, that was wow. That was when things started really selling off. But just to me, it was pretty danging. Because just like if someone answered that way, I'd say you're either not confident or you're being deceptive the way he responded. So yeah, we got 2 minutes and 42 seconds now till the closing bell, and that's probably about the time when Bitcoin sell-off's gonna maybe subside a little bit. I mean, normally it is if the selling. That's just what we've noticed when the stock market closes. If there was selling pressure and Bitcoin was going with the index fund, normally the selling subsides after the stocks close. Well, I think that's algos. But here we are. We are at those lows, the session lows, and again, the lowest low since the 18th. 4-day lows, but working on possibly 5-day lows. Whoa, man. But all happening only after all this time, right? All these candles, you finally hit the level a couple times, and that's where it's reversing. That's perfect, man. Welcome to the effing show. Yeah, Tron down 14%, getting sued by the SEC. Good. Couldn't have happened to a worse person. Look at that dump, man. Imagine owning Tron, like, for real. I mean, look, man. Hey, if there's some sort of like strategic edge, and it was a trade and all that, that's fine. But like, hey, man, I'm talking about to hold it without a plan, scam. True Northern Sun, understand that harmonic trading is literally in the exact same category as Elliott wave, okay, and other theories, right? So yeah, that's the theory, is the wave structures, and mine are just the M shapes. Elliott wave just doesn't seem to work for me. It doesn't really help me because there's just always multiple outcomes of a particular wave and stuff. It just doesn't, like, man, if something isn't helping me really line up with everything else, then I don't have it in my system, right? Everything's got to have its own reason for being in the system that I use it, and just Elliott wave just never really was helpful to me. Wells Fargo's at its session lows. Wells Fargo's at its lowest lows in a long time. Wells Fargo at its lowest price since June of 2022. There it is, chat. The banks, I told you earlier, the bank collapse is not over. It was just pausing for a few days, gap filled and dumping. My other alerts on banks will probably be triggering soon. 10 seconds until your closing bell. If you're enjoying the live stream, hit the like button, that bell, that sub. What a crescendo to the day. The banks getting wrecked. There it is, chat. A closing is confirmed. Jesus chimes. That's it, man. We did it. We made it. We made it. But yeah, after hours, look at this. I mean, Wells Fargo, immediately with no volume is up 1% after hours. This is where this blue line is. Something else. But yeah, and Bitcoin closed literally at its lowest lows of the 4-hour candle. And just go back to it real quick. I have another alert set up, man. You should everyone in here should have their alert set up below $37, because below $37 is like death. Like, that's death, man. Much, much lower below that. So set it up. I've just reset mine up. And like we were saying, there might be a little, relief because the stock market closed and selling pressure subsides. So maybe Bitcoin, right there at that 200 for now, a little green. These things happen. Yeah, so just letting you know, if you want to support this community, there's a great way to do it. It's very simple to do. But you can tip the stream and all that. But, if you want to learn more about traditional technical analysis and be connected to a premium Discord, with more people, people that are taking it very seriously, you join the Citadel. It's pretty easy. You just go to right here. You go to the top left and you go to server subscriptions, and right here joining the Citadel, you get trade setups, education, access to the premium Discord, emojis, all that stuff. You get a lot of amenities, but the single most important reason why you would join the Citadel or the Patreon is because you are supporting this 100% crowdsourced stream, where I've never accepted money from an entity and marketed it to you. I've never treated you as the consumer, right, for them. None of that. I don't monetize on YouTube. I play copyright music. I can't make money because every day I play copyright music. So these are just all the reasons why it's important to support someone who is crowdsourced. So that's the best way to do it. But when you do it, there's value involved. So it's like a win-win. Gold's still rallying, man. Right there near the highs. Something spectacular is happening. Litecoin is in the green today, if you can even believe it. Yes, Litecoin caught the bids, still below that $84 level. Kind of crazy because there was an M shape there. It was like a shark. Wow, look at this, man. I mean, that's, so a type 1, it's just a reaction. But look, how is it up today? I mean, you're at that $84 level. If you break that, there's just not much there till 105. So, an interesting development in the crypto space, Litecoin being up today with everything. And I'm talking everything down 5% or more. Pay attention to Litecoin. Back to Bitcoin here, of course, just right there when the stock market closes. This is just so generally, this is such a general thing. It happens all the time. Stock market's dumping, Bitcoin's dumping with it, and the stock market closes. Then Bitcoin rallies off of it. Yeah, so just paying attention to the price action. Thanks for the nearly 1,000 people tuned in. How many likes do we got? 491. We don't even have 500 likes. Dang, man, did I do something wrong? I guess I better drink, man. I better start drinking alcohol, because that's the only thing to wake people up these days, right? Yeah, Ethereum's working on a daily bearish golden candle. And unfortunately, breaking back below 1728.88. That's not good. I mean, that's like, okay, you're not holding support. You were trying to. But this is what I'm talking about. Like, Jerome Powell comes out, starts talking, the algos freak out, and then candles like this get painted, and so it's a failed breakout. I mean, that's what's happening. Failed bullish breakout, and you're falling back below the level you desperately needed to be above. You needed to. The downside potential could take you to 1420 below this based on history. Just know what's happening. The failed breakout's occurring. I think Tron is so screwed, man. I mean, the idea of the Bitcoin fractal is still not really invalid yet. Now, of course, I think if it was going to follow it to a T, it would have collapsed, back at the beginning of the year or end of last year. But something happened, and that was Bitcoin pivoted and rallied, and that took Tron with it. But the fact is, Tron has not made a higher high, I mean, in about a year or more. I mean, and I think even if it's a higher high locally, it hasn't made a higher high than its previous major high since the buying climax in April of 2021. So you're talking about, even here, you made the same high as the high from August, and now locally you're making a lower high, falling below the 200-day moving average. I mean, I think if you're seeing 5 cents one more time, it's over. You got to know how far Tron will fall, and it will be warranted, justified. I'll have a Tron, someone, and remind me, I'll have a Tron capitulation pizza party if Tron breaks 5 cents. We will celebrate together. It will be joyous. It'll be a party, okay? Only when Tron breaks 5 cents for real will we do that, okay? Pizza party. Just remind me, in case I forget. How can you forget that, right? And here we are, right? I mean, how the theory holds true, right? The stock market closes and Bitcoin recovers some, just a little bit off that. It's still way off though, right? I think it is from its high point to its low point. Dang, man, look at that. Almost an 8% swing on the largest crypto in the world. And just a couple hours. Insanity, man. It's the major league, dude. Yes, the wedge was broken. Absolutely. I mean, and here's the thing, on the daily, on Bitcoin on the daily, it's really not even a big deal. Like, oh my God, we tested it for the first time and reacted kind of violently. But look at it. That's just not, that doesn't deter me and make me be like, oh, well, Bitcoin's now not going to be the asset that saves the world from this dystopic, crazy Federal Reserve, central banks actually destroying small mid-cap banks. So therefore they get bought out by the already nationalized too big to fail banks, because those too big to fail banks were the ones that were collapsing in 2008. So this is like a process that started in 2008 and 9. And now they're completing it. They're working on completing it, corralling everyone into these big banks that are, just unlimited money, right? They can insure unlimited amounts, right, with the FDIC instead of 250,000. I'm talking like trillions of dollars. They just say that they can do that. So again, they'll get rid of all these small banks, and then it'll be very, very easy to usher in a central bank digital currency. But yeah, the only impediment right now for them doing that is just it's so spread out, and this is just a new dynamic, man. Governments getting involved with our money system like this is new in the West. It's not supposed to happen. It never had happened. China's doing it, of course, but everyone just keeps doing what communist China's doing. Yeah, communists, perhaps you've heard of it, killed over 100 million people. Yeah, that regime, we're just going to do what they do. We're just in the, weak men are creating bad times, and we're transitioning into the bad times. Unfortunately, that's just where we are in it. Anyway, man, whatever. I covered the stuff. I covered this. So I'm out of here. Definitely not going live like in a couple hours. I mean, this was the stream. So take it or leave it. Thanks for watching. Thanks, Mama Ivy and Bryce. Yep. Mama Ivy and Bryce. Respect the TA.